let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thanks for having me.
Wow, Fed Day, big day, Super Bowl. Was it a big day?
It was more like a divisional playoff round, arguably a wild card round, something like that.
So what did Jay come out and say? First of all, they held rates flat, right? So no change in rates. But what did they come out and say?
So the main thing that I was looking at today was the summary of economic projections. And there's three key areas: growth, unemployment, and inflation expectations, right? So to growth expectations, they slashed them, pretty meaningfully. I think 2025 growth was cut from like 2.2% GDP growth to 1.7. You also had an increase in the unemployment rate, expected unemployment rate from like 4.1 to 4.4, and you had inflation expectations also increase for core PCE. And so it really is a mixed picture. They're telling you that growth is going to be lower and unemployment is going to be higher, but that inflation's not going to come down as a result. And on top of that, the dot plot continued to suggest only 2 cuts this year. So it's a really strange mix of kind of inputs. And I think what it highlights is just the staggering level of uncertainty about policy on a go forward, right? The Trump administration is random at times and is very unpredictable. You're also, at a weird point in the business cycle, weird structural things happening in the economy where it's really hard to kind of forecast out what's going to happen on a go forward basis. And so, with the combination of fiscal policy uncertainty, geopolitical uncertainty, economic uncertainty, it's just really hard to know what to do. And I think what the Fed did today was kind of give themselves optionality with respect to how they're going to respond. The one thing of note as well was that they did reduce the pace of QT by 50%. That was a little bit of a surprise to markets. And the market reaction to this has been a little bit on the dovish side. You saw 2-year yields go from 4.08% to about 3.98%, so a rally of 10 basis points. And S&P rallied on the back of that, but really not a whole lot. And so the market perceived this as mildly risk positive. We'll see. It takes time for the market to digest information and really process it. But to be honest, I'm left with more questions than answers, truthfully. And, I think that's where a lot of investors, a lot of CEOs and CFOs, a lot of everyday people are. People are worried about losing their jobs. CEOs are worried about tariff policy and whether they should spend on CapEx, and so I think this is just a very uncertain environment, and it's really hard to want to be gung ho about risk if you just really don't know.
So is it? You said it was staggering. You said the word staggering, which had me thinking of the word stagflation. Is that kind of what we're looking at here?
That is precisely what the data suggests. And one interesting anecdote. So I looked at where core PC has been for the past 5 years, right? The Fed's stated objective is 2% core PCE. The last time we were at 2% core PCE was March of 2021. We have sustained above the Fed's mandated target for 4 years.
Right.
And they're still telling you transitory.
Mm-hmm.
And you have this huge tariff deadline coming up, April 2nd. You have the last batch of UMich data suggests that folks are expecting 4+% inflation on a 1-year basis, right? And so it's really hard for me to view the Fed as that credible in terms of like meaningfully getting in or having a strong willingness to kind of commit to getting inflation down, right? And I think they're really scarred a little bit by kind of the policy mistakes over the past, 5 years or so, right? Last year they cut rates by 100 basis points and rates went straight up, right? In post-COVID, they told you inflation was transitory, and it clearly wasn't. And so I think this is a Fed that is a little reluctant about getting too aggressive on hiking rates now. And yeah, so it's a really complicated mix of market and economic conditions, and so I truthfully, I'm just going to stay data dependent.
Yeah,
Like that's all you can do.
And this is causing chop, uncertainty. I mean, look at Bitcoin right over our shoulder here,
Yeah.
85K, right in the center of this 80 to 90 range. We've mostly been in the bottom part of that range, but again, pretty resilient. 82 feels like well, it's so far held. I know our friend Quinn Thompson thinks it's going down to 72. It's possible, right? But have you been surprised at all at like after that initial very scary drop from the 90s to like 79? Over the last, 2 weeks, we've basically been in the same, Bitcoin's been like a stable coin at like 82 to 85. Like, is that expression of uncertainty here, or what is that?
I think, you just kind of might have run out of sellers, but I also don't think there's like a ton of buying flow that's coming, right? So far, the Trump administration policies on crypto have underwhelmed the market relative to expectations.
Right, which is crazy because they've been almost everything that crypto had asked for.
Which is what was baked into the price.
Yeah.
And so, I really do think that, like, without substantive buying flow coming, like, it's really hard to kind of sustain.
Yeah.
And personally, I'm still a little bit bearish on broader risk markets from a valuation standpoint, from a fiscal standpoint, where the Fed, where the government is trying to cut spending by $1 trillion a year.
You've said this, maybe almost certainly the correct long-term thing, but obviously just bearish for near-term everything.
And Scott Bessent, like, is not flinching on the market point.
Right.
Like, he continues to reiterate that, the markets will have a detox period. And I don't know how you can view that as being constructive for risk.
He's literally saying it's not.
It's not.
Yeah.
And so, you go back to, the whole idea of if stocks aren't doing well, like, why would one expect crypto to do well?
Be unlikely.
Yes.
Historically speaking.
Correct.
Maybe one day. It does actually feel like, this is what I mean though, like 85K, 82K, et cetera, feels like a pretty healthy Bitcoin price if you take all the policies that have happened and stack them and without the flows, even just the policies, and stack them on top of the prior all-time high in the like low 70s from last year. That seems pretty reasonable. It turns out we know now there was about 20K of price froth related to the anticipation of the policies.
Yeah.
But 85K is still meaningfully higher year over year. It's also certainly, anyway.
Yeah, I would contrast that with the fact that gold is making fresh all-time highs.
Fair point.
Today as we speak.
Yeah.
Right? We are above $3,000 an ounce. There is strong buying flow from central banks. These aren't ma retail. This is...
So they're buying gold and not treasuries, treasury notes, bills.
They are... I can't speak to exactly the foreign holdings.
But they are buying gold.
They are buying gold,
Yeah.
and it is sending it way higher in price. I think it's around 20 trillion in market cap.
But you've seen a little. You said,
be.
Well, it just we've talked a lot about, and a lot of people on Wall Street have talked about how they, Trump, and for a variety of reasons, wants to push rates down, so yields down, push yields down, right? And we haven't really seen it yet on the right. Everyone's looking at the 10-year as the measure here, and it hasn't really come down that much, right?
Well, it did come down from like elevated levels like a couple months ago.
Right, but yeah.
By and large, like 10s at 430, like that's not a meaningful reduction.
That's what I'm saying.
And that doesn't ease financial conditions. And so I think there's a long way to go in terms of them achieving their policy objectives. And if you really want to see 10-year yields at 3.5 to 375-ish, like, you got a lot of wood to chop. You got to spend a lot less money. You got to fire more people.
Yeah, which is politically difficult.
Very difficult.
Yeah.
And to be honest, the one thing I keep thinking, and our CEO was talking about it on his podcast, How are you going to do this without touching entitlements? Social Security, Medicaid, Medicare, right? People like don't want that messed with.
Right. But it's a lot of the spend.
It's a lot of the spend. But at the same time, we're spending $1 trillion a year to service the debt.
Right. Just interest.
Just interest.
Yeah.
Right. And
Not paying any principal down at all.
Right. And so I think we have to be realistic about like what policy measures need to be used in order to actually achieve that outcome. And I think realistically it's every lever if you're trying to.
That's how big the problem is.
Yes. And it's going to be painful.
Yep. Well, that's it. We'll cut it there for now. My friend Beimnet Abebe from Galaxy Trading, thank you so much.
No problem.